All right, so this is just a quick example on vertical spreads. So a lot of members of the Discord were asking like, what is a vertical spread? How do you use it to take advantage of like diminished risk versus reward when trading options? Basically, a vertical spread is when you buy and sell a put at different strike prices in order to offset your costs. And depending on what strikes you buy or sell at, it will determine whether you are taking a bullish or bearish spread. Both puts and call spreads can be either bullish or bearish. But for the sake of simplicity, we're going to talk about a vertical debit call spread, which is a bullish call spread. So with a bullish call spread, what you're doing is you are buying a call at a lower strike price and then selling a call at a higher strike price. And the net effect of that is that you are paying, you're offsetting your cost of purchasing the lower strike price by selling a call that's a little bit higher. And in an ideal scenario, what will happen is the price of your the price of the stock will go above both of those option strike prices, and that will result in max profit for you. The beauty of vertical call spreads is that because you are buying and selling a call that are very close to their same price, you are setting a maximum profit, but you're also setting a much lower risk by offsetting your cost. So I'll do this in Webull to try and illustrate what I'm talking about. So if we go and buy a 2.5 strike call, okay, we want to buy that call. Let's see if we can do a vertical here. Okay, so this is a vertical call strategy with Prog. This is what we're doing. So right now, the limit price of these options are, we'll go based off of the last price. So we're looking at the last traded price. So if we buy a call for $2.50 strike for 20 cents per contract, and then we sell a call for $3 strike at 14 cents per contract, we're setting ourselves at a 6-cent difference. So we're actually paying a net total of 6 cents per contract. And look at that, we can even get a little bit of a discount here because they've kind of the spread between them has narrowed a little bit. So it's more like a 5% difference, which is good. We actually want that. So let's go back to our order and say we wanted to buy 10 of these. Go ahead and set a limit price of 5 cents. And so we'd be buying at a 5-cent difference. I'm not sure if I can actually trade with this account because I don't think I have the money. Yeah, I don't have any money in this account. But if we were to take this spread, then what we would be doing is we would be buying this call and selling this call at the same exact time for their market price. So if we were to do a market order, the actual debit would be $150 based on just the current market price. And then you would call this a 250/3 vertical call spread. So this is what actual max profit loss would look like with this type of spread. So right here, our maximum with a vertical call spread, the way it works is your max risk is whatever you paid for the options. So if you're paying a total of $100, then that's the most you can lose. But on the other hand, you set yourself with a maximum gain of 350, which that's like what 100. That's like a 125% profit. Did I do the head math right? I don't know, but essentially, you're paying $150 for the chance to get a total net 350 profit out of that entire spread. And the beauty of this is that it trains you with discipline because it forces you, like, once the call goes in the money, once both of these calls go in the money, then you have a certain maximum that you can actually make off of it, and it will never go higher than that, at least not by a significant margin. It might go, there might be some messing around with like volatility and things like that where the spread between the two options will kind of widen or narrow, and that can kind of have an effect of a few dollars on your trade. But at the very least, like, you have a defined maximum that you can get out of this trade. And it trains you to be like, okay, I'm like within a few dollars of my max profit. I'm just going to close the trade because it will never be better than this. And that's kind of how you have to think as an options trader when you're dealing with long calls and long puts, because you're fighting theta the whole time. And a lot of people, when they start trading, get in this trap of like, well, it could go higher. Like, there's unlimited potential, but that's not realistic. So, vertical call spreads are a great way to offset your risk by lowering your entry costs. It gives you a max profit that's well defined, so you have a clear price target. You know what you're looking for, you know when your entries and exits are, and you have, like, the most you can lose is whatever you put in the trade. So by doing this, like, it just more clearly defines your goals and what you're looking for with your strategy. And there's almost there's almost no chance of unlimited risk, just because there is the potential for this to, like, get weird because of early exercising. So that's one thing to be careful of with these strategies, is that because this call has been sold, technically if it runs in the money, somebody could early exercise on you, and then this call would still be out there for you to exercise, and you would need to exercise it in order to get those calls back and then deliver them. So that's one thing to be careful of. So just keep that in mind. But for the most part, like, this is a much diminished risk trade, just because your entry fee is so low and your max profit is so well defined that you can, like, if you hit that target, you're like, okay, I know that this is my time to get out. So go ahead and clear this order entry.
And another small side thing before we get into the go-to one is this is another really good one. I feel like for getting into the uh, bigger market cap stocks that normally people can't afford to do options for. So I think that'd be another really good example to show how that can be utilized, because that's how I was doing a lot of my plays as well.
Oh, so we're talking like IBM maybe?
IBM, NVIDIA was a big one I did for a while that worked for a long time, but then I got a little greedy on it. But there are, yeah, a lot of good examples of that are just, those triple digit, numbers that normally people are a bit like, oh yeah, I can't, afford $1,000 option type of thing. You know what I mean?
Yeah, that's true. That's actually a really good point. So, like, for one of the big advantages of call spreads is that it gives you the ability to trade in stocks that are like so much higher strike price, or rather so much higher stock price, which usually is like a bar to entry, and that prevents you from being able to trade options. Like, if you look at the price of these options for January on IBM, like, you would want to trade this, but the options are so expensive. Like, 238 is pretty high for a lot of people. This is $238 per option. So with a vertical call spread, you can enter with that in the money strike price, and you can play based off of that strike. So if we were to say, go ahead and add this to our order book, and then set up a vertical call spread, we can actually set this up with a limit order. And then if we wanted to buy just a single spread is $60. And that's much easier, much more affordable if you wanted to trade this. But then if we look at the graph of this, what the max profit loss is, we risk for $60 on this one, with the potential for a $40 gain. let's see if we can play with the strike prices and maybe get a little bit better potential, because we want to maximize our we want to lower our risk, but we want to maximize our potential profits.
So I may actually have a good example for you if you'd like.
Sure, let's go for it.
So Microsoft, because we'll even bump it up to an even more expensive, more volatile one.
Sure.
So Microsoft next week will go close to in the money. Let me see here because I was just looking at this one.
Perfect. Let's go for, what do you want to do? 7th of January or 14th?
We'll do the 7, so we even just go a bit closer because with this example, what I find interesting is if you go on a higher cap stock, you could, of course, go at a wider spread, which you're still able to do at a dramatically lesser price because obviously those sold calls on a higher dollar stock that are further out of the money by 10, $15 isn't going to be the same 10, $15 that a prog calls out of the money. Like that one's not going to be worth pretty much anything at that point, whereas these
Right.
couple of dollar moves for these bigger stocks are very easy to do. So I think 7th, and then as an example, if we were expecting, let's just say the 340, 345, so we'll go slightly in the money. So that's even because you're talking, you're paying an extra premium to be a little even with that regard. So keeping
Mm-hmm.
that in mind, that's still only $220, and your upside. And just a good quick way to do the mental math on the max profit I've found is every dollar in between a strike obviously is $100, and then just subtracting your premium. So 225 minus the 5, you'd be at 275 for max profit. So that's over 100% for Microsoft moving $5 by next week from where it's at, like already being in the money.
Yeah, that's pretty impressive actually. So you risk $138 on this entry with just a single strike separation between the vertical spread. So these are just one strike price level apart. So in this case, the one that I'm illustrating here on screen, you would be setting yourself up for a spread betting on the price going up by just $2.50. And if you did meet that, then what you would end up with is a $112 profit per contract. So
Absolutely.
so with like, we'll say like 5 contracts, you can risk yourself a little less than $700 with the potential to make a max profit of 560. And if you wanted to widen the spread as well, then you do increase your cost, but your profit potential goes up significantly. And in that case, you're betting on it going up by $5. So your entry is still a little more expensive, but it's still less than if you just had bought a long call outright. And you, by doing so, you limit your risk and you set yourself with a cap of what you can take max profit. And that just helps with like mental discipline. And even like uh, beyond that, like now you have a clear price where you don't even have to watch it anymore. You can just set yourself at a limit and just sell it when the price hits this. So if you see the stock or if you see the option approach these levels, you can just set yourself with a limit sell right at yeah, when the stock price hits $345, just go ahead and sell it, and then like you'll never get a better price than that. You won't get more profit than that, and you don't even have to watch it at that point. You just set yourself up with like, okay, here's my entry, and this is my price target, and I'll just let my broker trade for me at that point.
Absolutely. And one other thing to add to that as well, and this is partially how I would do some of the, because I was kind of playing with it. You could either go wider on the spread, right? And, still kind of stay in the money. So you could do like a 10, 15, $20 spread if you really think it's going to run, or you could do 5 to 10 $2.50 spreads closer to the money and just get that gap no matter what it does, crazy or just a couple bucks, and kind of still get the same profit. And then averse to that, if you really think it's going to go crazy, you can do the same thing just farther out of the money. So as an example, if you look at the same week, but let's just say Microsoft had earnings or some sort of announcement, you could do a 355, 360 spread that cost you $15 and the max profit is 485.
350, 365.
$3.55, 360 as an example. Right now it's trading at 18 cents. So like if you can get it, maybe let's say at 15 for easy math, $15 for that contract. That spread is $5. So 500 minus the 15 would be $485 of profit per contract.
I even like this one a little bit better. You're risking 140 per contract with the width of $10. And like you look at charts, you look at Microsoft's chart. This is just one trading week right here. This movement right here, that's one trading week. That's over $30 a movement. This could easily run in the money, and you could lock in this profit. Like this is a really good call spread. The pricing and it's good to play with these because Weeble's an excellent platform for pricing these out, even if you're not trading on Weeble. But yeah, I like these graphs. I'm so glad that I looked at this. Like to be honest, I'm actually thinking about actually buying this spread now because of how good the trade looks. Like it's
I
$140 risk for the potential gain of a almost $5,000. That's a really good spread, and there's a good chance that it could run in the money. Like Microsoft, what has it been trading on the daily? Yeah, it did a double bottom here, and it's testing resistance right now. So if it breaks through 145, 146, if we look at this on a technical level, right there. So if we see Microsoft start to challenge that price, yeah, 349, like that's a really good margin. Like you're giving yourself with this case, you're setting your entire spread out of the money. So you're lowering the cost significantly, but you're increasing your risk, or you're decreasing your probability of success. So there's an offset here, right? When you look at this option, the both of the strikes are deep out of the money, technically. For Microsoft, it moves by like $10 every day. So, whatever. But if you look at this exact spread here, and you think that within a week that Microsoft could move up to 365, if it did that, move by $15, then you give yourself such a excellent risk to reward probability, because your probability of success in this case is like if we were to look at the delta for these options. I like to use delta when I look at options to determine my probability of going in the money. So let's see, what did we say here? 355, 365. So if we look at the delta of these options, 355 and 365 have a delta of 0.02, and 355 has a delta of 0.1. So if you convert this to a percentage and then consider that like my air quotes probability of success or going in the money, then this has a 10% chance of going in the money, and this option has a 2.5% chance of going in the money. And if you think of it like that, like that's the chance you are taking. But when you consider that Microsoft might like say this has earnings, or if there's some potential catalyst, and this can apply to any stock, um, then you might be looking at an excellent risk to reward setup.
And to that point, I actually, because you hit it so perfectly, nail on the head to a kind of what I guess the amalgamation of all these things finally came to be when I was doing it and during that whole earnings play situation, because I started to find those that's not a fluke. Like obviously what you found, like those are just how spreads work, right? So when you have an event like that that's coming up across, multiple different companies, how we had that crazy, several earnings weeks in a row, all you really know is that there's movement. And you might be able to say like, oh yeah, Nvidia's might, move, Netflix might, you can make your theses, but generally you just know there's going to be movement. And what I found with these is when you're looking at obviously what even percentage is that return 120 to 5,000, you know what I mean? So you truly at a certain point, if that's kind of your strategy and how you play things and you're doing multiple plays at once, you really only need but so many of those to be successful for you to just be, it's pretty seriously net green. Because if let's just say you did the $120 bets and you did 20 of those and one of them hit, you're already good. You know what I mean? Like in that regard, you know what I mean? So it's yeah, it's an interesting way to go about it.
Yeah, exactly. So I hope that this kind of helps illustrate the benefits of call spreads, making the most out of your risk to reward and lowering your costs. Like if you're going to do some crazy YOLO options and you really are that convicted that and convinced that that's going to play out in your favor, don't do a long call and like create a massive cost for yourself. Do a vertical spread and you lower your cost, but you still give yourself like this extremely good advantage of like now I'm only risking $100 versus risking 1,000. You know what I'm saying? So like if I were to just convert this to a long call and purchase these outright, then my costs will go way up. But on top of that, it's also like the same risk that I'm gonna like my calls are going to burn. So it's such a you're putting yourself at a disadvantage of almost guaranteed failure. But if you're going to do that, then and you're so convinced that that is a trade that's going to work out for you, then lower your cost any way that you can, and you will almost guaranteed maximize your profits if it plays out for you, because that way you're not going to be tempted to wait to see if it goes any higher than that and like run the risk of having the rug pulled out from underneath you.
Yeah, and if there's just one more thing I could tack onto that, another huge thing, and this is something that I have, and I'm sure everyone can relate to who trades options. Theta is horrible, and theta, just like letting options sit, is the worst thing you can do. Traditionally, you want movement every moment you hold those options. With spreads, I have not experienced that same decay at all because of the balance that they both have. So this is another huge part of being able to a little bit more confidently allow your play to move without theta and it just being sideways killing you. I mean, now if your stock goes down, you go way out of the money, obviously that you're going to start seeing red. But if it stays sideways, it, if anything, the closer you get to expiration, the higher the odds that spread is going to be profitable if it's close. So you're actually going to see an increase even if it just stays sideways, because now your probability's gone up. Versus it where theta would just eat you alive if it was sideways on calls.
Right. So I'm going to have to get off of the recording here very shortly. But does anybody have any other questions before we close out this lesson? Still no questions? All right. I'm gonna trust that everybody understood, but feel free to leave a comment if you didn't understand anything or if you're still uncertain, not sure exactly how it works or how this might work on your platform. But just letting you know that this is technically a level 3 option strategy, so you have to have access to naked call rights. Um, that's only because technically, when you're doing this, you are writing a naked call, even though you're also buying a call at a lower strike price so that you will offset your collateral. You will not have that same collateral risk. You still technically have to trade this as a level 3 option strategy, which does put you at the risk of some weird things happening with early exercises and stuff. So, a lot of brokers will restrict this type of trading to L3 options trades. But at the same time, the way that it works out, it's actually like one of the least risky option strategies that you can ever possibly work with. So it's kind of weird how that works out. But feel free to drop some questions and comments in the Discord. You can always reach out to myself or Kat. Both of us are happy to help give some more information or clarify things.